In this learning objective, we'll prepare a report showing activity variances. Activity variances are simply the difference between our planning budget revenues and expenses and our flexible budget revenues and expenses. Our planning budget was what we expected to do in terms of an activity level before our operating period began, and our flexible budget is based on our actual level of activity. And again, the difference between these arises purely because of a difference in the level of activity or output. Let's go ahead and look at Larry's lawn service, and let's use the flexible budget we prepared for Larry's lawn service to calculate our activity variances. Recall, our planning budget was based on 500 lawns. Our revenues for our planning budget of $37,500 was simply our 500 estimated lawns times $75 per lawn, while our flexible budget revenues of $41,250 is the 550 lawns we actually cut multiplied by our expected average price of $75 per lawn. And we have a $3,750 difference, and in this case a favorable activity variance. And again, our activity variance will be favorable because we were able to cut 50 more lawns than we had anticipated. On the expense side of things, all of our activity variances in this case will be unfavorable because the increase in the number of lawns we cut will cause our expenses to increase. For instance, wages and salaries both had a $500 fixed component in both the planning and the flexible budget, but the variable component was $30 per lawn, so 30 times 500 for the planning budget, whereas with the flexible budget it was 30 times 550. Again, all of our activity variances for our expenses will be unfavorable because our activity level was higher than we had originally anticipated. Notice, our activity revenue increased by 10%, but net operating income increased by more than 10%. This is because some of our expenses, such as equipment maintenance, office and shop utilities, office and shop rent, equipment depreciation, and insurance, are fixed, and our fixed costs remain constant regardless of our level of output. And so our revenues went up by 10% when our activity increased by 10%, but our expenses went up by less than 10%, causing an overall increase in our net income. Let's go ahead now and calculate some activity variances. Flight Cafe is a company that prepares in-flight meals for airlines in its kitchen located next to the local airport. The company's planning budget for July and flexible budget for July for 17,800 actual meals served appear below. Prepare a report showing the company's activity variances for July. Which of the activity variances should be concerned to management? Again, down below we have our planning budget, which was based on 1,800 expected meals, and the flexible budget, which is based on our actual number of meals served, which was 17,800 meals. Since the actual number of meals is 200 less than we had originally planned, overall, we would say our activity variance is unfavorable. Our revenue variance is $900. Our flexible budget amount was 900 less than we had originally planned, and we would say this is an unfavorable variance since our flexible budget revenues are less than our original plan. And this isn't surprising since we served fewer meals. For our expenses, raw materials are $480 less in our flexible budget than in our planning budget. Again, this is because we've served fewer meals. Since our expense is lower, we would say that this is a favorable variance. Our wages and salaries, the difference is $60, and again, since our flexible budget amount is less than our original plan, it is a favorable variance. We'll see that all of our expense variances are favorable since our activity level was lower than we had originally anticipated. The difference for utilities is $10, again, a favorable variance. There's no variance for facilities rent since it was a fixed cost in both our planning and our flexible budget. The same is true with insurance, while maintenance has a $20 favorable expense variance. Overall, our total expense variance is favorable by $570. This is again because our actual level of activity is less than our original planned level of activity. In terms of our net operating income, the difference between our flexible budget net operating income of $14,821 and our original planned net income of $14,820 is $330. This is a favorable variance, unfavorable variance.